Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are looking at a dividend stock that we haven't spoken about in this channel for a long time. As you can see here, before we get to that, just a couple of housekeeping. So as you can see, the portfolio still doing all right, about right now about 15.5% or over £8,000 in gains. So this week hasn't been as great as last week, okay, last 2-3 weeks, but it's been all right. So everything looks really expensive right now. Some of the companies that I wanted to add to this week, I didn't, because I felt like they were a little bit too expensive. They've gone up too much last 3 weeks. So let's quickly talk about one of the things that has happening next week, and that is the earnings report. So on Monday we've got Palo Alto and Zoom and a couple of other companies reporting. The one I'm interested in is on Tuesday we got Medtronic reporting on Tuesday, and I'm interested to see what they say in terms of supply chains and things like that, because last time they reported, basically the stock actually went down quite a bit, so the price actually went down quite a bit. So it will be interesting to see on basically what happens. So they're reporting before the market opens. Advanced Auto Parts is reporting on that same day, but after the market closes. And then on Wednesday, we've got some of the big boys reporting. We got Nvidia. Nvidia has already told us that it's not going to be a great report, so it will be interesting to see what it's like. Salesforce is another company that I'm basically looking forward to. They have done really well so far. I mean, they are almost, I think, if not in the green right now for me. Okay. Then we've got Snowflake and a couple of other companies that are reporting. So basically a couple of companies that we own, we have in our portfolio are reporting next week. The one I'm really interested as well, and on Thursday, is the VMware. Because VMware is basically being acquired by Broadcom. So I want to see what they say, where they're at in the process so far. So it will be really interesting to see what VMware says in terms of that. But yeah, so that's what's happening next week. We'll see how that goes. Let's get started and look at this company that we're talking about today. And that company is Ecolab. This company provides water, hygiene and infection prevention solutions and services in the United States and internationally. This company do pay some dividends. I think this company is one of the stocks Bill Gates owns in his portfolio. Is in the material sector. We're currently trading $171 per share. They have EPS right now $3.83. Next year they're expecting to grow that about $581. Market cap of almost $49 billion. They have wide economic moat. The beta is slightly above 1, but it's not that much. PE is very, very high right now. But when you look at the 5-year average PE, which is about 48, is actually below that. So that kind of tells us the price basically is a little bit undervalued at the moment if you think about it. Because the reason I didn't have this before, so the reason I added to basically this, and from now on we'll share this with you, is because it gives us an idea of where the stock has been in the last 5 years. So if the PE is actually a lot higher, current PE is a lot higher, the 5-year average, then you know the stock's quite expensive. But when you know it's actually below the 5-year average, then that means it is possibly undervalued. The material sector is only 8.57, but the material section is actually really, not all of them are cheap, but they normally tend to have a lower PE. Again, you need to look the average to know exactly where it's been. So price to free cash flow, again 48, so similar to the 5-year average. They do pay some dividends, so 1.19% dividend yield, payout ratio 44%, and 5-year growth rate of 7%, which is very nice. Dividend growth rate of 30 years, so they have increased that dividend for 30 years. And it's 98% safe, which is really good. They do have $1 billion in the bank, okay, as a free cash flow. I absolutely love free cash flow. I love to invest in companies that have a free cash flow here and a nice free cash flow yield, because, if anything happens to the company, at least they have money in the bank that they can use, right? And one of the other things they can do is they can actually buy back shares, they can give you dividends, they can actually pay off debt, so acquire other companies. There's a lot of things they can do with that cash. So cash is king, like they say, right? 5-year revenue growth, revenue growth is about 7%. 10-year EPS growth is about 7.43%, which is really nice. And then when you look at profit margins, about 8%. So we're normally looking about 15%, and our operating margins basically is below what we're looking for, which is about 12. Return on equity about 15, so it's above what we're looking for. Is online, basically in line with what we are looking for. And then total returns in the last 10 years, we're looking at about 11%, which is very nice. Current ratio is above 1, which tells us this company has enough money in the bank for the next 12 months to pay off any debt that they have in the next 12 months. So the current ratio, basically, can they pay off their current liabilities in the next 12 months? And the answer is absolutely yes. When we look at the analyst expectations in terms of valuation, okay, so the expectations for next basically 5 years is this business is supposed to grow their earnings about 12% every single year. And Simply Wall Street is actually saying 17.8% undervalued at the moment. Fair value price is $213 per share. Morningstar is actually saying is undervalued at basically 18% right now, discounted, and fair value 215. So quite similar, if you like, in these two companies. Tip rank is about 5%. They're saying $181 per share. Yahoo Finance is also saying about $80 per share, and according to Tip rank, is actually moderate buy. Now, this seems really good company. I mean, I have actually never looked at this company. I knew it existed out there. I think I included a video that I did a very, very long time ago, but I've never actually looked at it. When you look at it from PE perspective, it seems very expensive. From everything else, I think it's okay. PE, that's the only thing I'm just concerned about. Now, the next part that we're going to look at is the outstanding shares. Okay, so when you look at the outstanding shares, now this is important. Why is this important? Because you want your company to buy back shares. Okay, you don't want them to dilute the shares that you own. Now, what that means is the company will issue more shares. So the one share that you had before is no longer worth basically it's the same value as what it was before, right? But when they buy back their shares, your one share is now worth more, if you think about it, right? Some companies will dilute their shares, and the reason they do that is because they're still growing. So companies like Salesforce, right, that are still in the growing phase, they will dilute their shares. Companies like Adobe, I think, is stopped now. There's a lot of companies, especially in the tech world, that actually dilute the shares. Why? Because they're still growing, and instead of getting a loan from the bank, they use that money. Okay, they issue new shares. They use that money to reinvest in the business, and so they can actually grow their business, which is fine. But once it gets to the position where like the growth phase is over, then they need to buy back those shares as much as they can. And I do like companies that buy back their shares. I think it was a Home Depot that just announced yesterday that they actually planning to, I think it was a $15 billion or $18 billion. So they've actually approved that about $18 or $15 billion of buyback to buy back their own shares, and which is really, really good. So you gain the dividends as well as you get in the basically the buyback shares, right? So yeah, that is one of the reasons I like this. Okay, so it's very nice to have companies that buy back their shares. A healthy business will grow obviously their sales as well. So as you can see here, it's been up and down a couple of years. I think especially with 2020, it went down quite a bit. Okay, from 12.6 to 12 and 11.8, but in terms of 2021, it's actually bounced back to 12.7, and now they're expecting to grow that 13.5. So in terms of total sales, basically it is heading definitely the right direction. Okay, and yeah, so this is one of those companies that I haven't actually spoken about basically for a long time, and it seems undervalued at the moment, even according to their basically the dividend yield. Okay, basically the company looks actually undervalued. So what they do is the dividend yield, the average dividend for the last 5 years was 1. If the current dividend is above 1, then that means the stock is actually undervalued. If this was say 0.9%, then will be under this line, and that will mean is overvalued. So that's how they basically look at, and this is the website, one of the websites that I use is called Simply Save Dividend. So they have their own methods of basically trying to find it. This works only for dividend stocks, unfortunately, but you could do probably the same thing. Okay, so again, if you're really interested in this company, then you need to go to their website, look at the basic in terms of water side of it. What do they do? What are the solutions they have? Food, healthcare, climate, all of these things. So yeah, so one of the things I would do definitely is go to the investors section. Normally you can find it at the bottom of the page somewhere. okay, and then see if you could, if I can find it, that is, there you go, investors. You go to that section and you can find a lot more information about the company that's tailored for you. So next thing I will do, if I was really interested, I'll look at their earnings report, okay, I'll look at it, basically any presentations that they've done recently, okay, and then that will give you an overview of how much money this company is making per year. You can see the highlights and so on. So it's really interesting. You can see the write-up about what the company has done in terms of sales, in terms of operating income, and then they can tell you anything that's happening to the company in the next 5 to 10 years, or next basically 2 quarters, 3 quarters, and so on. And then you can do the comparison between this quarter and last quarter and so on. I hope you enjoyed the video. That's all I wanted to share with you today. Have a wonderful day. If you don't like this kind of content, please like the videos and subscribe to the channel. Have a wonderful day. Assalamu Alaikum.